Then we have the question, what is the free cash flow for 2014? Well, free cash flow is the amount of cash that could be withdrawn without harming the firm's ability to operate and to produce future cash flows. It is calculated as after-tax operating income plus depreciation, less capital expenditures and the change in net operating working capital. It is more important than net income because it shows the exact amount available to all investors, stockholders, and debt holders. The value of a company's operations depends on expected future free cash flows. Therefore, managers make their companies more valuable by increasing their free cash flow. Net income, on the other hand, it just reflects accounting profit, but not cash flow. So investors should be focusing on this cash flow rather than the accounting profit. And you can see from the calculation that you get the free cash flow for 2014 is negative $744,000. Based on this situation is a bad sign, but it's not always a bad sign in every situation. Many rapidly growing companies have negative free cash flows because the fixed assets and working capital needed to support rapid growth generally exceed cash flows from existing operations. That is not bad, provided the new investments will eventually be profitable and contribute to the free cash flow. Now let's look at some other performance measures that we can use to evaluate manager performance. So accounting statements aren't always the best because they don't reflect market values. So we have market value added as one choice, and it's the difference between a firm's market value and the book value of its equity. The higher a firm's market value added, the better the job management is doing for the firm's shareholders. Economic value added is the difference between a firm's after-tax net operating profit and the annual dollar cost of capital. Companies, through their managers, create value and realize positive economic value added if the benefits of their investments exceed the cost of raising the necessary capital. If economic value added is positive, then after-tax operating income exceeds the cost of capital needed to produce that income, and then management actions are adding value for stockholders. Positive economic value added on an annual basis will help ensure that market value added is also positive. And here are the equations for those two. So market value minus book value, and then we have EBIT times 1 minus the tax rate. And then we have this subtracted total invested capital times the cost of capital. So let's look at the market value added in 2014 and 2013. Well, remember the price per share dropped to $2.25 in 2014 because the stock market reacted negatively. And so that's going to be $225,000 minus $492,592. And so you see that we have a negative market value added, which means that the company basically destroyed shareholder wealth. And then in 2013, the market price was $8.50 per share times 100,000 shares outstanding. And so this one, in 2013, they had created shareholder wealth because it was a positive 186,000. So I already discussed pretty much the stuff that's on this slide, the relationship between economic value added and market value added. And the basic idea is that when you generate positive economic value added, then that leads to a positive market value added. So we already know that De Leon does not pay its suppliers on time. So what are some of the consequences that might occur if suppliers are not paid on time? So you can see that from its accounts payable balance, it increased by 260% from the past year, while sales increased by only 76%. So company records would show if they paid suppliers on time, and by not paying them on time, De Leon is straining its relationship with them. If they continue to be late, eventually suppliers will cut the company off and put it into bankruptcy. Does it appear that De Leon's sales price exceeds its cost per unit sold? It does not seem to be the case, because if you look at the income statement, the company is spending more cash than it is taking in, and as a result, the cash account balance has decreased. Now, what if we did something like this? What if the sales manager decided to offer 60-day credit terms to customers rather than 30-day credit terms? Well, if you extend the sales credit terms, it will take longer for De Leon to receive its money. Its cash account would decrease and its accounts receivable would build up even more. Because the collection process would slow down, accounts payable would build up too. So then, inventory would have to be built up and possibly fixed assets also before sales could be increased. Accounts receivable would rise and cash would decline. Much later, when collections increased, cash would rise. De Leon would probably need to borrow or sell stock to finance the expansion. So this would be a very bad idea, and I hope, well, that they don't do this. So how did they finance the expansion? They basically financed it with debt. It was short-term debt and long-term debt. And the short-term debt was the notes payable. The next question is, would they have required external capital if they had broken even in 2014, saying that their net income had equaled to zero? And assuming that they were going to make that huge $711,000 investment in fixed assets, then they would still need to have to raise more funds just due to that alone because of the cost. If they didn't raise any more fixed assets, then the situation would have been different. Or if they didn't purchase any more fixed assets, I mean. And then another question is, what happens if they depreciate fixed assets over 7 years as opposed to the current 10 years? This would have no effect on the physical stock of the assets, but the balance sheet account for net fixed assets would decline because accumulated depreciation would increase by the fact that they're depreciating assets over 7 years versus 10 years. Because depreciation expense would then increase, net income would decrease. Finally, the firm's cash position would increase because its tax payments would be reduced. So you can see how doing one little thing has a kind of a very complicated effect. And that is the end of chapter 3.